On January 15, 2026, the United States Department of Agriculture released a report that shattered the heartland. Official trade data confirmed that American agricultural exports to China collapsed by $7.4 billion in just 1 year. This is not a projection or a pessimistic forecast. It is the cold, hard reality of the 2025 fiscal year. For decades, American farmers were told that feeding the dragon was the path to permanent prosperity and stability. We were promised that the immense population of China would always need the corn and soybeans grown in the Midwest. But that promise has officially been broken, and the trade relationship has been severed in a way that looks permanent. The 54% drop in export volume is the single largest year-over-year decline in modern agricultural history. It represents a catastrophic failure of trade diplomacy and a turning point for the entire American economy today. If you want to understand the financial reality of this crisis, you must subscribe to this channel right now. Hit the notification bell so you are alerted immediately when we release these urgent economic updates. We are the only channel digging into the raw USDA data to bring you the truth about the trade war. Leave a comment below telling us if you think the government is doing enough to protect our farmers. I read every single comment to see how this agricultural crisis is affecting your local community and prices. The data, released by the Foreign Agricultural Service, paints a bleak picture for the future of American trade. The report details how the $7.4 billion loss is spread across multiple critical sectors of farming. The hardest hit commodity was the soybean, which saw a staggering loss of $2.7 billion alone. For years, the soybean was the golden ticket for farmers in states like Iowa and Illinois and Minnesota. Entire local economies were built around the expectation that China would buy 60% of the harvest. But in 2025, the ships that usually carry those beans across the Pacific sat empty at the ports. The Chinese buyers simply did not show up, and the orders that were expected never materialized on the books. This sudden disappearance of demand sent shockwaves through the futures markets in Chicago instantly. Prices for soybeans plummeted to levels that make it impossible for many family farms to break even this year. But the crisis is not limited to soybeans. It extends to corn and wheat and other staple crops. Corn exports to China fell by over $1 billion as Beijing canceled shipments without warning or explanation. The ripple effects of this cancellation are being felt in every rural town that relies on agriculture income. When farmers do not sell their crop, they do not buy new equipment or trucks or invest in land. The machinery dealerships and the seed companies are already reporting massive declines in sales for the first quarter. This is the start of a recession in the rural economy that will eventually reach the cities and suburbs. The report also highlights the complete failure of the Phase 1 trade deal signed back in 2020. That agreement was supposed to guarantee that China would purchase billions of dollars of American farm goods annually. It was hailed as a victory for the American farmer and a guarantee of future sales for years to come. But the 2026 data proves that the deal was nothing more than a temporary pause in hostilities. China never met its purchase targets, and now they have stopped pretending to try to meet them at all. The political will to enforce the deal has evaporated in Washington, and Beijing has moved on to new partners. This leaves American farmers holding the bag for a geopolitical struggle that they have no control over. The USDA report explicitly states that China is actively diversifying its food supply away from the United States. They are no longer viewing America as a reliable partner, but as a strategic adversary to be avoided. This shift in mindset is what makes this current collapse different from previous trade disputes we have seen. In the past, trade wars were temporary spats over tariffs or quotas that were eventually resolved with negotiations. But this time, the Chinese have spent years building a new supply chain that excludes the American farmer completely. They have invested billions in ports and railways in South America to facilitate the flow of grain from there. The $7.4 billion loss is the direct result of that infrastructure investment finally coming online. It means that the market share we lost is not coming back, even if the political situation improves tomorrow. The structural damage to the trade relationship is deep and likely irreversible for the foreseeable future. American farmers are now facing a world where their biggest customer has become their biggest competitor. The excess supply of grain that is now sitting in silos across the Midwest has nowhere to go. Storage facilities are overflowing, and farmers are being forced to pile corn on the ground in massive mounds. This visible sign of surplus is a depressing reminder of the economic value that is rotting away daily. The financial strain on the agricultural sector is beginning to show in the banking data as well. Community banks in the Farm Belt are reporting a sharp increase in loan delinquencies in the last quarter. Farmers who took out operating loans expecting a normal harvest sale are now unable to pay them back. The $7.4 billion hole in the economy is being filled by debt that cannot be serviced. This is creating a liquidity crisis in rural America that rivals the farm crisis of the 1980s. But unlike the 80s, there is no easy government solution to fix the problem of lost demand. Subsidies and bailouts can keep farmers afloat for a year or two, but they cannot replace a customer. The US government cannot force China to buy our grain if they have found a cheaper alternative elsewhere. And the data shows that they have indeed found a cheaper and more politically aligned alternative in Brazil. The shift to Brazilian suppliers was not an accident, it was a calculated strategic move by Beijing. They spent a decade cultivating the relationship with Brazil specifically to reduce their dependence on the United States. The USDA report acknowledges that Brazilian exports to China surged at the exact same time ours collapsed. It is a zero-sum game where every dollar lost by an American farmer is gained by a Brazilian one. The efficiency of the Brazilian agricultural machine has improved dramatically in the last 5 years alone. They have cleared millions of acres of land and adopted advanced technology to boost their yield significantly. But the real game changer has been the currency exchange rate, which favors Brazilian exports over American ones. The strong US dollar makes our grain expensive on the global market, while the Brazilian real is cheap. This currency disadvantage makes it impossible for American farmers to compete on price alone in a global market. When you combine the price disadvantage with the political tension, you get a perfect storm for export collapse. The $7.4 billion figure is just the headline number, but the details are even worse. The loss of the Chinese market removes the price floor that has supported American agriculture for 20 years. Without the massive demand from China to soak up the excess supply, prices will remain depressed indefinitely. This means that the profitability of farming in America has been fundamentally reset to a lower level. Land values, which have been soaring for a decade, are now at risk of a significant correction downward. Farmers who leverage their land to expand their operations are now underwater on their balance sheets. The wealth destruction that is happening in real time is staggering and largely unreported by national media. They focus on the stock market highs, while the foundation of the rural economy is crumbling silently. But the signs are everywhere if you know where to look in the data and the communities. Equipment auctions are filled with late model combines and tractors that farmers can no longer afford to keep. Rural main streets are seeing businesses close as the flow of farm dollars dries up completely. The $7.4 billion that vanished was money that circulated through these small towns daily. It paid for haircuts and groceries and tuition and healthcare for millions of families in the heartland. Now that money is gone, and it is being spent in the rural towns of Mato Grosso, Brazil, the strategic failure of the U.S. trade policy has resulted in a massive transfer of wealth abroad. We allowed our geopolitical rival to develop a competitor that has now eaten our lunch entirely. The USDA report tries to put a brave face on the situation by highlighting other markets. They talk about increased sales to Mexico and Canada and parts of Southeast Asia as potential replacements. But the reality is that no other country on earth has the appetite of China for soy. You cannot replace a billion-person market with a few smaller countries, no matter how hard you try. The mathematics of the situation are brutal and unforgiving for the American agricultural producer today. We are producing too much food for a world that is becoming more fragmented and protectionist. The era of free trade that allowed American agriculture to thrive is officially over as of now. We have entered a new era of strategic decoupling where food is used as a weapon of war. And in this new war, the American farmer is the one on the front lines taking the casualties. The $7.4 billion loss is just the first salvo in a long and painful conflict. It is a warning shot that tells us the old rules of the global economy no longer apply. We need to rethink the entire business model of American agriculture if we want it to survive. We cannot continue to plant fence row to fence row expecting a buyer that is no longer there. The adjustments that will need to be made are painful and will result in significant consolidation. Fewer farmers will survive this crisis, and the ones that do will have to be much leaner. The corporate consolidation of farmland will accelerate as family farms are forced to sell out to investors. This changes the social fabric of rural America in ways that we are only beginning to understand. The $7.4 billion is not just money, it is the livelihood of a generation. It represents the broken promise of a government that failed to protect its most essential industry. As we look at the specific breakdown of the losses, the picture becomes even more concerning for us. The decline in meat exports, specifically pork and beef, also contributed to the total loss figure. China had been a growing market for American protein as their middle class expanded and demanded more meat. But that trend has also reversed as they focus on domestic production and imports from other nations. The comprehensive nature of the decline suggests a total boycott of American food products is underway. It is a silent embargo that is not written in any law but is visible in every chart. The question now is, how deep is the bottom and have we reached it yet today? The answer to how deep the bottom goes lies in the jungles of South America right now. While American farmers were battling regulations and rising costs, Brazil was busy building a superhighway to China. The completion of the BR-163 highway has fundamentally changed the logistics of global agriculture forever. For decades, the biggest advantage the American farmer had was the mighty Mississippi River transport system. It was cheaper to float grain down the river to New Orleans than to truck it across Brazil. But that advantage has been erased by billions of dollars in infrastructure investment by the Brazilian government. They paved the roads that connect the massive soy fields of Mato Grosso to the northern ports. This cut the trucking time and the cost of shipping grain to the waiting vessels by half. The ports of the Northern Arc are now some of the most efficient export terminals in the world. They were built specifically to load the massive Panamax ships that carry food directly to Chinese ports. This logistical revolution means that Brazilian farmers can now compete with Americans on speed and price. And because their land is cheaper and their labor is cheaper, their break-even price is lower. The Chinese government saw this potential and poured investment capital into Brazilian rail lines and storage facilities. They effectively built their own supply chain that bypasses the United States and the Panama Canal completely. This strategic partnership is the engine that is driving the $7.4 billion collapse today. It is not just about price. It is about food security and geopolitical alignment for the next century. Brazil is a member of the BRICS alliance, which China views as the future of global trade. They prefer to buy from a partner that is not threatening them with sanctions or trade wars daily. This political preference creates a structural ceiling for American exports that no amount of efficiency can break. Even if American farmers grow the best crop in the world, they cannot overcome a political blockade. The impact of this shift is visible in the massive stockpiles of corn sitting in Iowa elevators. Farmers are holding onto their harvest, hoping for a price rally that the data says is impossible. The market is flooded with Brazilian corn, which has also seen a record harvest in 2025. Their safrinha, or second corn crop, was massive and hit the market at the worst possible time. This double whammy of record global supply and vanishing Chinese demand is crushing the American price structure. Corn prices have fallen below the cost of production for the first time in several years in America. This brings us to the second half of the disaster, which is the rising cost of inputs. While the price farmers receive for their crop has crashed, the price they pay to grow it has not. Seed companies and fertilizer manufacturers have kept their prices high to protect their own profit margins. The cost of diesel fuel and machinery parts remains elevated due to inflation in the broader economy. This creates a margin squeeze that is suffocating family farms that operate on thin margins already. The USDA data shows that net farm income is projected to fall by 25% this year. This is the largest year-over-year decline in farm income since the commodity bust of 2016. It means that farmers are working harder and producing more, but taking home significantly less money at the end. The gap between revenue and expenses is being filled by working capital reserves that are draining fast. Many farmers are burning through the cash they saved during the profitable years of 2022. Once that cash is gone, they will have to turn to operating loans to put a crop in. But with interest rates remaining higher than the historic average, those loans are expensive to service now. The Federal Reserve's fight against inflation has inadvertently made the farm crisis significantly worse for rural borrowers. A 7% operating note eats up a huge chunk of the potential profit from a cornfield. When you combine high interest rates with low commodity prices, you get a recipe for financial ruin. This is the exact same dynamic that led to the farm crisis of the 1980s in America. Back then, it was a strong dollar and high interest rates and an export embargo that triggered it. Today, we have a strong dollar and high interest rates and a de facto Chinese embargo happening. The parallels are terrifying for anyone who remembers the foreclosure auctions on the courthouse steps back then. The strong US dollar is a major headwind that gets very little attention in the national press. Because the dollar is strong relative to the Brazilian real, our exports are automatically more expensive globally. A buyer in China or Egypt or Mexico looks at the price tag and sees a premium. They can buy the same bushel of corn from Brazil for 20% less just on currency. This currency arbitrage is devastating for American competitiveness in a world where every penny counts for buyers. The Federal Reserve has no plan to weaken the dollar just to help the agricultural export sector. Their priority is fighting inflation in the services sector, not saving the export market for soybeans today. This leaves farmers trapped in a macroeconomic vice that is squeezing the life out of their operations. The $7.4 billion loss is just the revenue side of the ledger for the sector. If you add in the increased interest expense and input costs, the total economic loss is higher. It is estimated that the rural economy will lose over $20 billion in economic activity this year. This money would have supported local schools and hospitals and main street businesses in small towns. Instead, it is vanishing into the black hole of debt service and foreign competition that is winning. The machinery sector is the canary in the coal mine for the wider rural economic collapse. Major manufacturers like John Deere and Case IH are already seeing order cancellations pile up fast. They are reducing production shifts and laying off workers in factories across the Midwest right now. When farmers stop buying $200,000 tractors, the factory workers stop buying new cars and houses. The economic contagion spreads from the farm gate to the factory floor in a matter of months. This slowdown is already showing up in the regional GDP numbers for the Plains states this quarter. States like Nebraska and Kansas are seeing economic contraction, while the coastal states are seeing growth still. It is a bifurcated economy where the producers of real goods are in a depression-like state. The disconnect between the rural reality and the Wall Street narrative has never been wider than today. The stock market hits all-time highs, while the people who feed the country are going broke. This resentment is fueling a political backlash that will have consequences in the upcoming midterm elections, surely. Farmers feel abandoned by a government that promised them trade deals and delivered only trade deficits. They were told that the trade war would be short and easy to win for the country. Instead, it has turned into a long war of attrition that they are slowly losing to Brazil. The Chinese strategy of strategic patience has outlasted the American political cycle and patience effectively. They waited us out and built their alternatives, while we argued over tariffs and quotas in Washington. Now the infrastructure is built, and the trade routes are established, and the damage is done. You cannot unpave the roads in Brazil, and you cannot force the Chinese to buy American corn. The structural shift is permanent, and the American agriculture sector must shrink to fit the new reality. This shrinking process is what economists call consolidation, but farmers call it losing the family farm. The smaller operators who cannot spread their costs over thousands of acres are the first to fall. They simply do not have the scale to survive on the razor-thin margins that exist today. The vultures are already circling in the form of real estate investment trusts and foreign buyers. They are waiting for the land prices to crack so they can swoop in and buy cheap. This brings us to the most dangerous part of the crisis, which is the land market bubble. For a decade, farmland values have defied gravity and marched higher every single year without fail. They were driven by low interest rates and high commodity prices, and the belief in scarcity. But now the interest rates are up, and the commodity prices are down, and the demand is gone. The math that supported $20,000 an acre for Iowa dirt no longer works on paper. Land is valued based on the income it can generate, and that income has just collapsed. If the land market turns, it will wipe out the equity of every farmer in the country. Farmers use their land equity as collateral to get the loans they need to operate every year. If the value of that collateral drops, the banks will call the loans and force liquidations instantly. This is the nightmare scenario that keeps rural bankers awake at night in 1980 and today. We are seeing the first cracks in the land market in the auctions happening this month, actually. Farms that would have sparked a bidding war 2 years ago are now receiving no bids at all. Sellers are pulling their listings because they cannot get the price they need to pay off debts. The liquidity has dried up because the buyers know that the $7.4 billion is gone. They know that without the Chinese buyer, the land is not worth what it was last year. The repricing of American farmland is the next shoe to drop in this unfolding economic tragedy. It will destroy billions of dollars in paper wealth that farmers were counting on for their retirement. The illusion of wealth created by inflating land values masked the deterioration of the underlying business model. Now that the mask is ripped off, we are left with a sector that is structurally unprofitable. The government subsidies that used to plug the gap are no longer sufficient to cover the losses. The crop insurance programs were designed to protect against weather disasters, not geopolitical trade disasters like this. There is no insurance policy for losing your biggest customer to a competitor in South America. The lobbyists in Washington are scrambling to ask for a new bailout package for the sector. But with the national debt soaring and the budget deficits exploding, the appetite for bailouts is low. Congress is paralyzed by gridlock and unlikely to pass a massive farm rescue bill this year. This leaves the farmers to face the storm alone with whatever resources they have left in reserve. The survivors will be the ones with no debt and massive scale, but they will be few. The landscape of rural America is being redrawn by decisions made in Beijing and Brasilia today. The sovereignty of our food supply is being eroded as our production capacity is hollowed out. We are becoming a residual supplier to the world rather than the dominant force we once were. The shift from dominance to dependence is a painful psychological blow for the American agricultural psyche. We always believed that the world needed us more than we needed the world in trade. The data from 2026 proves that this arrogance was our downfall in the global market. The world found a way to eat without us and saved money in the process of doing it. Now we are left with the surplus and the debt and the empty silos in the Midwest. The transition to part 3 of this disaster will explore the banking contagion that is starting. This surplus is not just a pile of grain, it is a pile of unpayable bank loans. The banking contagion that starts in the cornfields does not stay there for long. Community banks across the Midwest are holding the paper on this agricultural disaster right now. These small institutions are the lifeblood of rural America, and they are heavily exposed today. When a farmer cannot pay his operating note, the bank takes a direct hit to its capital. And unlike the massive banks on Wall Street, these community banks do not get federal bailouts. They are forced to absorb the losses or close their doors permanently and hurt the town. The latest data from the Kansas City Federal Reserve shows a sharp tightening of credit conditions. Bankers are becoming increasingly reluctant to lend money for the 2026 planting season. They are demanding more collateral and higher down payments than most farmers can afford to pay. This credit crunch is the final nail in the coffin for the struggling family operations. Without access to credit, they cannot buy the seed and fertilizer needed to plant a crop. This forces a wave of forced liquidations that will accelerate in the coming months rapidly. We are already seeing the early signs of this in the Chapter 12 bankruptcy filings data. Filings for family farm bankruptcies have nearly doubled in the first quarter of 2026. States like Arkansas and Wisconsin are becoming hotspots for legal restructuring and farm failures. But bankruptcy is a lagging indicator that tells us what happened 2 years ago financially. The real-time data suggests that the distress is much more widespread than the court filings show. Thousands of farmers are quietly selling off parcels of land just to stay afloat another year. They are cannibalizing their own operations to pay the interest on their mounting debts daily. This slow-motion liquidation is tragic because it destroys the legacy of multi-generational farms. The land that has been in a family for 100 years is sold to a hedge fund. This transfer of ownership from families to corporations is the hidden cost of the trade war. It changes the character of rural America from a community of owners to a land of tenants. The tenant farmers who remain will work the land, but they will not own the wealth it generates. That wealth will be extracted and sent to investors in New York or London or Beijing. The $7.4 billion loss in exports has catalyzed this transfer of wealth efficiently. It has weakened the American producer to the point where they are vulnerable to hostile takeover. And the irony is that the United States is now running an agricultural trade deficit globally. For the first time in history, we are importing more food than we are exporting by value. The Department of Agriculture projects a trade deficit of nearly $50 billion this fiscal year. This is a shocking statistic for a nation that prides itself on being the breadbasket of the world. We are buying expensive wine and cheese and out-of-season fruit from other countries. Meanwhile, we cannot sell our own basic commodities like corn and soy to the world market. This trade imbalance is a symptom of a broader economic sickness that affects the entire nation. It shows that our production costs have become too high relative to our global competitors today. The strong dollar and the high cost of regulatory compliance make us uncompetitive in a free market. Unless these structural issues are addressed, the deficit will continue to widen every single year. The impact of this deficit spills over into the machinery and equipment sector very quickly. When farmers are losing money, they stop buying the massive machines that harvest the crops. Sales of large tractors and combines have fallen off a cliff in the last 6 months. Inventory is piling up on dealership lots across the country with no buyers in sight. This forces the manufacturers to cut production and lay off workers in their factories immediately. We are seeing shift reductions at major plants in Illinois, in Iowa, and North Dakota. These are high-paying manufacturing jobs that support families and sustain local tax bases effectively. When those jobs disappear, the local schools and police departments lose their funding sources too. The spiral of economic decline widens from the farm to the factory to the town square. It is a reminder that agriculture is not just about farming, it is about the industrial base. The steel and the rubber and the technology that goes into a tractor is all American-made. If the farm economy collapses, the industrial supply chain collapses right along with it instantly. This is why the $7.4 billion loss matters to every single American citizen. It is not just a rural problem, it is a national security problem of the highest order. A nation that cannot feed itself or sell its food is a nation that is vulnerable. We are ceding our food sovereignty to nations that do not share our values or interests. The reliance on imported food leaves us exposed to supply chain disruptions and price shocks. We saw what happened during the pandemic when global trade routes were suddenly shut down. Imagine that scenario applied to our basic food supply in a future geopolitical conflict. The strategic wisdom of outsourcing our food production is highly questionable at best right now, yet that is exactly what the current trade policies are encouraging by default every day. The lack of urgency in Washington to address this crisis is baffling to many observers. There are no emergency hearings being held to discuss the collapse of the export market. There are no massive trade delegations being sent to find new buyers for our goods. The response has been a collective shrug from the political class that is focused elsewhere. They seem content to let the market sort it out, even if it means mass bankruptcy. This laissez-faire attitude is a stark contrast to the aggressive support other nations give. Brazil and China and Russia actively support their agricultural sectors as strategic national assets. They build infrastructure and negotiate aggressive trade deals to ensure their farmers succeed globally. The United States is resting on its laurels, assuming that we are too big to fail. But the data from 2026 proves that we are failing and failing fast. The world is moving on without us and finding new partners to trade with today. The BRICS alliance is creating a closed loop of food and energy trade that excludes us. This geopolitical realignment is the most significant shift in power since the Cold War ended. And agriculture is the tip of the spear in this new battle for global influence. By losing the Chinese market, we have lost our leverage in the most important relationship. We used to say that China needed us too much to ever truly challenge us militarily. That theory was based on the idea that they needed our food to prevent starvation. But now that they have secured their food supply from Brazil, that leverage is gone completely. They are free to challenge us on Taiwan or the South China Sea without fear of famine. The $7.4 billion loss is a strategic defeat that weakens our national defense. It emboldens our adversaries and demoralizes our allies who see our economic power waning. We need a complete rethink of our agricultural strategy to survive in this new world. We need to focus on rebuilding our domestic markets and processing capacity right here at home. Instead of exporting raw soybeans, we should be processing them into renewable fuels and products. We need to create value-added industries that keep the wealth in our local communities. We need to diversify our export partners so we are never held hostage by one nation. We need to invest in our own infrastructure to make our transport systems competitive again. But most of all, we need to recognize the value of the family farm to our society. It is not just a business, it is a reservoir of culture and values and resilience. If we lose the family farm, we lose a part of the American soul that cannot be replaced. The warnings from the Farm Belt are loud and clear for anyone willing to listen. The distress signals are flashing red on the dashboards of bankers and farmers alike today. We are standing on the precipice of a change that will reshape our country for decades. The decisions we make in the next year will determine if we remain an agricultural superpower, or if we slide into irrelevance as a former giant that lost its way in the world. The $7.4 billion is gone, and it is not coming back to us. The question is, what will we do to stop the next $7 billion from leaving too? Will we fight for our farmers, or will we let them become casualties of globalism? The answer to that question will define the future of the American heartland for generations. It is time for the American public to wake up to the crisis on our doorstep. We cannot eat stock prices, and we cannot live on imported food forever safely. We need a robust and independent agricultural sector to ensure our freedom and prosperity. That starts with acknowledging the severity of the collapse we are witnessing right now. It starts with holding our leaders accountable for the failures of trade policy and diplomacy. And it starts with supporting the men and women who work the land every day. They are the backbone of this nation, and they are breaking under the weight of this crisis. We must stand with them and demand a future where American farming can thrive again. Thank you for watching this 3-part series on the crisis in American agriculture. We have covered the trade collapse, the Brazilian competition, and the banking contagion in detail. This is a complex story with many moving parts, but the conclusion is simple and stark. We are in trouble, and we need to act now before it is too late to save it. If you found this series informative, please share it with everyone you know today. The algorithm does not like this kind of hard economic truth, so we need your help. Share it on social media and email it to your friends and talk about it. The more people who know the truth, the harder it is for them to ignore it. Make sure you are subscribed to the channel so you never miss our future investigations. We will continue to track this story as it develops and bring you the latest data. Leave a comment below with your thoughts on the future of American farming and trade. Do you think we can turn this around, or is the era of dominance over? I will be reading your comments and engaging with the community in the discussion section. Thank you for your time and for caring about the real issues facing our country. Until next time, keep your eyes on the data and your mind open to truth.